Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'll be guiding you through the latest news and trends in the financial markets. Today, we're starting with a couple of interesting stories that caught our attention. First up, we have Phoenix Mills's subsidiary, Island Star Mall Developers, raising 1,100 crores through non-convertible debentures. This move is expected to help the company reduce its debt and improve its financial position. But what does this mean for investors? We'll be taking a closer look at the implications of this development and what it could mean for the future of Phoenix Mills. Next, we're looking at the recent rally in Reliance Industries stock, which jumped over 2% to reverse losses made in the last 2 days. This comes after billionaire Mukesh Ambani laid out ambitious plans for the conglomerate during the AGM, highlighting AI and FMCG as new growth engines. But that's not all. A Morgan Stanley report suggests that Reliance is set to benefit from China's push to curb overcapacity in various industries, including energy and solar supply chains. The global brokerage has given Reliance a target price of ACC 2 with an overweight rating. We'll be examining the details of this report and what it could mean for investors. We're also keeping an eye on Phoenix Mills' stock, which has been upgraded by several brokerages following the company's recent announcement. The company's subsidiary, Island Star Mall Developers, has raised 1,100 crores through non-convertible debentures, and we'll be discussing what this means for the company's financial position and future prospects. Lastly, we have some interesting news from Phoenix Mills, with several brokerages upgrading the stock after the company announced that its subsidiary, Island Star Mall Developers, has raised 1,100 crores through non-convertible debentures. The company has also received an upgrade from Motilal Oswal, which has set a target price of 50 on 19,450 on the stock. As we delve into these stories and more, we'll be providing you with a balanced view of the market, highlighting both the opportunities and risks. Our goal is to help you make informed decisions about your investments and stay ahead of the curve in the ever-changing world of finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the world of finance and explore the latest developments that could impact your investments. I'm your host, Lewis, and today we're looking at a fascinating story that's making waves in the bond market. It seems like Japanese investors are flocking to Indian bonds, and this trend is having a ripple effect on the global economy. But before we dive into the details, let's take a step back and understand what's driving this phenomenon. According to reports, Japanese investors are seeking higher yields abroad due to the low interest rate environment in their home country, and India, with its relatively high bond yields, has become an attractive destination for these investors. In fact, Indian government bond yields are expected to remain stable ahead of a heavy state debt supply, with traders preparing for a substantial supply of state government bonds. But here's the interesting part. This influx of foreign investment is not only boosting India's bond market, but also having a knock-on effect on other economies. For instance, we're seeing Indian states aim to raise a whopping 316.5 billion rupees through the sale of bonds, which could lead to a surge in demand for these securities. Now, let's take a look at what this means for investors. On one hand, the increased demand for Indian bonds could push yields lower, making them less attractive to investors seeking higher returns. On the other hand, the stability of India's bond market, coupled with the potential for higher yields, could make it an appealing option for those looking to diversify their portfolios. As we navigate this complex landscape, it's essential to consider the broader implications of these trends. For example, how might this impact the global economy? And what does it mean for investors who are already exposed to emerging markets? To provide some balance to our discussion, let's also examine the potential risks associated with investing in Indian bonds. As with any investment, there are no guarantees, and investors should be aware of the potential pitfalls, such as changes in government policies or economic downturns. In conclusion, the story of Japanese investors flocking to Indian bonds is a fascinating one that highlights the interconnectedness of global markets. As we continue to monitor these developments, it's crucial to remain informed and adapt our investment strategies accordingly. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We've had a fantastic discussion so far, and now it's time to wrap up with our closing segment. As we dive into the world of finance and risk management, it's essential to stay informed about the latest market trends and news. Today, we're looking at the current state of the global markets, and there are several key factors to consider. The U.S. stock market has been experiencing a record-breaking rally, but September is historically the weakest month of the year for U.S. markets. Tariff tensions and questions over the Fed's independence are also compounding the risks. In Asia, we're seeing a mixed bag, with some markets rebounding after losses on Monday, while others are declining. The Japanese market is particularly worth watching, as the country's 10-year government bond auction will be a key test of investor appetite amid growing expectations of rate hikes by the Bank of Japan and mounting political uncertainty. Meanwhile, emerging market equities have had a boost from AI-related stocks in Hong Kong and China, with Alibaba jumping 19% in Hong Kong after reporting a triple-digit percentage gain in AI-related product revenue. However, it's essential to approach this news with caution, as the CBOE Volatility Index is sitting at relatively low levels, which could indicate that investors are becoming too complacent. It's also worth noting that longer maturity bonds may be in for a treacherous September if history is any guide. Over the last decade, government bonds globally with maturities of over 10 years have posted a median loss of 2% in September, according to data compiled by Bloomberg. As we navigate these complex market dynamics, it's crucial to remain informed and adapt to changing circumstances. At the Riskwiser Zone, we're committed to providing you with balanced and unbiased analysis to help you make informed investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe. And until next time, invest with caution.